The clock is already running. In 48 hours, a federal rule designed to stabilize the precious metals market will force U.S. banks and exchanges to meet new physical backing requirements for silver contracts. Regulators argue the measure is preventative. Markets see something else. A system built for abundant supply is about to collide with a market running dangerously short of metal. Silver inventories have been thinning for years, but the past 18 months shifted the conversation from imbalance to crisis. COMEX registered stockpiles have drained at the fastest pace since 1980, including a 37.6 million ounce collapse in just 47 days, a loss comparable only to the months preceding Silver Thursday. Banks in Asia froze retail purchases earlier this year. China restricted public access to bullion. Backwardation has emerged, signaling immediate demand outweighing future delivery, the clearest sign of physical stress. The new rule arrives at the worst possible moment. Futures markets have long operated on the assumption that most contracts settle in cash, not metal. That assumption kept liquidity high and prices stable, even as the paper-to-physical ratio grew increasingly distorted. Today, the ratio no longer looks like leverage. It looks like exposure. Behind these numbers sits a deeper structural issue. Industrial consumption has overtaken investment demand, pulling more than half of global supply into sectors that cannot slow down: solar, automotive electronics, medical devices, defense systems. The deficit is real, persistent, and accelerating. Multiple independent analyses now show silver consumption exceeding mining output for consecutive years, with the gap widening rather than closing. This means the new rule does more than increase compliance costs. It forces institutions to compete for a shrinking pool of deliverable metal, not because regulators intended to spark disruption, but because the system they are correcting has already crossed into instability. Where these pressures lead in the days ahead may shape the next phase of the silver market. And with the rules set to activate in less than 48 hours, the adjustment will not be theoretical. It will be immediate. The market entered 2025 with expectations of tightening conditions. What arrived instead was evidence of outright strain. Physical inventories across major exchanges continue to fall, but the velocity of the drawdown reshaped the conversation. Registered silver on COMEX dropped to levels that no longer resemble a functioning buffer. At one point, more than 37 million ounces disappeared in under 7 weeks, marking the steepest extraction since the early 1980s. Pressure is no longer isolated to Western markets. South Korean banks halted silver sales without warning. China restricted public purchases through its banking system. Russia, disconnected from Western trading floors, redirected flows toward domestic and allied industries. Each move signaled a system reaching for supply that isn't easily available. This tightening sits on top of record industrial demand. Silver's role in solar cells, electric vehicles, 5G towers, medical technologies, and defense hardware has transformed consumption patterns. Industrial usage now accounts for nearly 60% of global demand, up sharply from a decade ago. Solar alone absorbed almost 200 million ounces last year, eclipsing earlier forecasts and turning seasonal tightness into structural pressure. Mining output has failed to respond. Global production has either stagnated or declined due to grade erosion, limited capital expenditure, and the geological constraints facing an industry where 70% of supply comes as a byproduct of other metals. These dynamics restrict any short-term rebound. Even optimistic forecasts acknowledge that meaningful new production requires multi-year development cycles, time the market no longer has. Above-ground inventories filled the gap for several years. That reservoir is evaporating. COMEX, LBMA, and private vaults have all reported multi-year lows. The disappearance of liquidity in Asia and Europe adds another layer of stress. In normal markets, futures prices trade above spot to reflect storage costs. But silver has flipped into backwardation, with immediate delivery commanding a premium over future supply, a signal that buyers fear the metal may not be available when contracts mature. This is the environment into which the new physical backing rule arrives. Institutions accustomed to sourcing metal quietly, efficiently, and at scale must now secure tangible inventory against obligations that were once theoretical. The rule does not create scarcity, it reveals it. And with only 48 hours before enforcement, markets are preparing for the first real test of a system built on leverage rather than metal. The forces driving silver demand today are not cyclical. They are structural, embedded in long-horizon technologies and national policies that cannot easily reverse. The energy transition alone has altered the metal's trajectory. Solar photovoltaic installations now consume more than 197 million ounces annually, a figure that doubled in only a few years and continues to climb as governments accelerate renewable energy mandates. This demand is insensitive to price. Utilities do not adjust panel output based on commodity fluctuations. They absorb costs because the alternative is regulatory non-compliance. Electric vehicles add another unyielding layer. Every EV requires roughly twice the silver of a combustion engine due to expanded wiring, power electronics, and onboard computing. China's vehicle output increased sharply last year, contributing to a surge in industrial demand that now accounts for nearly 60% of global consumption. This shift reduces the market's ability to self-correct. Even if investors step back, manufacturers cannot. Data infrastructure reinforces the trend. 5G networks, AI data centers, high-density circuit assemblies, and medical technologies each rely on silver's exceptional conductivity and reliability. Substitution is limited. Copper oxidizes, aluminum loses efficiency. Alternative alloys reduce performance. Technology moves forward, not backward, and each iteration integrates more silver, not less. This means every breakthrough expands long-term load on an already stressed supply chain. National strategies are amplifying demand even further. Russia's decision to designate silver as a strategic reserve metal marked the first such move by a major nation in more than a century. China's industrial dominance has created a parallel dynamic. They produce less than they consume, forcing heavy imports that tighten global flows. Their restrictions on public buying, coupled with continued state accumulation, signal a strategic prioritization of industrial security over market transparency. Behind these headline forces lies a more subtle pressure. The monetary environment has shifted. Rate expectations are falling. The dollar is weakening. Central banks have accumulated record levels of gold in recent years, and that behavior is beginning to spill into silver markets as confidence in fiat stability erodes. Investors are no longer asking whether precious metals are necessary. They are asking whether waiting carries greater risk. Demand, in other words, is no longer responding to price signals. It is responding to policy, technology, and scarcity. And as the new physical backing rule approaches, these forces position silver not as a speculative asset, but as a constrained resource at the center of multiple strategic agendas. That is the environment institutions must navigate when compliance begins. The pressure on supply is even more uncompromising than the forces expanding demand. Global mine output has not kept pace with industrial consumption for nearly a decade. Production peaked in the mid-2000s and has flattened or declined since then, constrained by geology, capital discipline, and the realities of a sector where roughly 70% of silver appears only as a byproduct of lead, zinc, copper, and gold mining. When base metal economics weaken, silver supply falls with them. It is a structural limitation, not a cyclical one. Primary silver mines offer little relief. Grades continue to decline, operating costs continue to rise, and permitting timelines have stretched across North and South America. Even optimistic project schedules require 7 to 10 years to move from discovery to commercial production. In a market experiencing multi-year deficits, that timeline functions less as a solution and more as a reminder that supply cannot respond quickly enough to stabilize conditions. Recycling, often presented as a buffer, provides only a partial offset. Industrial scrap recovery captures a fraction of what is consumed. Electronics contain silver in quantities too small to recover economically at scale. Solar panels trap silver for decades before end-of-life processing becomes possible. Even under ideal conditions, recycling contributes less than 200 million ounces annually, insufficient against a structural deficit approaching or exceeding 100 million ounces per year. Exchange inventories tell the sharper story. COMEX registered stocks have been drained repeatedly, collapsing to levels that reflect stress rather than normal flow. the 37th. 6 million ounce drawdown in just 47 days was not a routine rotation of metal, but a withdrawal event reminiscent of 1980, when tightness morphed into a market-wide rupture. LBMA vaults show similar depletion, with available float shrinking as ETFs, industrial consumers, and sovereign buyers absorb what remains. Access constraints are emerging globally. South Korean banks suspended silver sales entirely. Chinese banks imposed purchase restrictions. Russia exited Western exchanges under sanctions and began prioritizing domestic allocation. Each disruption reduces the flexibility of global supply chains. None of them expand available metal. Market behavior now reflects these constraints. Backwardation, spot prices trading above futures contracts, reveals reluctance to trust long-dated promises. It signals the market's shift from confidence in future delivery to a scramble for what exists now. In mature commodity markets, backwardation is an exception. In silver, it is becoming a warning. This is the environment the new physical backing rule enters. Exchanges built on leverage will need metal. Banks accustomed to managing exposure through derivatives will need metal. Industrial players already struggling to secure uninterrupted supply will need metal. But the pool they are drawing from is shrinking quickly, and in some regions, it is already inaccessible. Supply constraints, in other words, are not just tight, they are structural. The system cannot expand output fast enough to meet policy-driven demand, and inventories cannot refill at the pace they are being drained. With 48 hours before the new rule activates, the real question is not whether the market can adapt. It is whether the system can absorb an additional layer of physical demand without breaking under the strain. The effects of tightening supply do not move linearly. They cascade. When inventories fall and regulatory pressure rises simultaneously, the market begins adjusting across multiple layers at once. Prices react first, but price is only the surface expression of deeper structural shifts. What follows reflects the interaction of liquidity, confidence, and physical scarcity. The futures market is the most immediate point of impact. Elevated physical backing requirements force institutions to reevaluate exposure they once considered routine. Positions built on leverage now require metal, not margin. That shift compresses liquidity, widens bid-ask spreads, and raises volatility. The CME outage last November offered a preview. Silver spiked violently, spreads blew out, and normal price discovery fractured as participants struggled to navigate uncertainty. Delivery pressure compounds this effect. As more contract holders demand physical settlement, registered inventories drain faster, pushing the system toward the limits documented across COMEX and LBMA vaults. Once backwardation settles in, with spot prices exceeding futures, participants begin prioritizing immediate delivery over long-dated exposure. The market stops trusting tomorrow's promises. It starts paying for guarantees today. Institutional behavior shifts in parallel. Banks that once treated silver as a peripheral asset now face regulatory incentives to secure physical inventory. Their accumulation further tightens supply, amplifying the very imbalance the rule seeks to stabilize. Hedge funds, seeing reduced liquidity and expanding volatility, reposition accordingly. Some exit paper exposure. Others attempt to front-run physical scarcity. Either way, the system becomes more fragile. Industrial users feel the next wave. Manufacturers operating on just-in-time supply chains begin stockpiling, not because they expect immediate disruption, but because the risk of non-delivery outweighs the carrying cost of excess inventory. The result mirrors the early stages of every historic commodity squeeze. Firms buy first to avoid being last. Silver's role in solar, electronics, and EV production makes this pattern more acute because substitution is limited and delays carry financial penalties. Retail markets amplify the pressure. Dealers report rising premiums when physical scarcity emerges, often long before futures markets reflect similar stress. During past dislocations, coins and bars sold at 40 to 60% above spot, revealing the divergence between theoretical supply and actual availability. As inventories tighten today, the premium structure is poised to adjust again, signaling another layer of stress beneath the official price. Geopolitics adds a final destabilizing force. China and Russia's strategic accumulation redirects flows that previously supported global liquidity. Restrictions on public silver purchases in Asia combined with banks halting sales, reveal a breakdown in distribution channels. When nations treat silver as a strategic asset rather than a commodity, the market begins to behave less like a tradable instrument and more like a finite resource. These reactions are not isolated events. They interact, reinforcing each other. Regulatory tightening accelerates institutional buying. Institutional buying drains inventories. Inventory depletion drives industrial stockpiling. Stockpiling deepens backwardation. Backwardation undermines futures market credibility. At each step, confidence erodes and scarcity intensifies. With 48 hours before the new rule takes effect, the question is no longer whether these reactions will occur. They have already begun. The remaining uncertainty is how quickly they converge and what the market looks like once they do. The next phase of the market will be defined less by price action and more by structural adjustment. Once the new physical backing rule activates, institutions will confront a constraint the futures market has spent decades avoiding: the need to secure real metal. That requirement transforms silver from a liquid trading instrument into a finite asset with limited availability. The policy may stabilize long-term market integrity, but the transition period introduces the risk of sudden, uneven repricing. The most immediate implication is compression of the paper market. Open interest that exceeds physical inventory by multiples will require recalibration. Some positions will unwind voluntarily. Others will be forced out by margin requirements and collateral shortages. This is the same dynamic observed during earlier stress events, including the November exchange outage, when a temporary halt triggered outsized moves and signaled how sensitive the system has become to unexpected shifts. Industrial users will react next. Firms tied to solar, automotive electronics, and high-density manufacturing already operate under rising procurement uncertainty. Persistently high premiums or extended delivery times could force them to renegotiate contracts, alter production schedules, or seek strategic stockpiles of their own. This mirrors the early stages of past commodity crises, when industries shifted from lean supply chains to defensive inventory strategies. In silver's case, this adjustment is magnified by the absence of viable substitutes across core applications. Global policy responses will follow. Nations that rely on imported silver for technology, energy, and defense may formalize stockpiling strategies similar to Russia's recent shift toward precious metals reserves. Countries with domestic mining potential may accelerate permitting or introduce incentives to increase production, though the lag between investment and output limits the immediate impact. Others may impose export restrictions, prioritizing domestic industries over global supply. Financial markets will need to adapt as well. A tightening in the silver complex often spills into correlated assets, mining equities, energy transition technologies, and inflation-sensitive commodities. If backwardation persists, it will raise questions about the broader reliability of paper contracts across metals markets. Should confidence erode further, regulatory bodies may face pressure to intervene more aggressively, repeating a pattern seen in earlier commodity crises where rule changes became tools of stabilization. The investor landscape will evolve in parallel. As physical scarcity becomes more visible, demand may shift from speculative trading toward long-term allocation strategies. Premiums in retail markets, already rising during episodes of strain, could become a structural feature rather than a temporary distortion. ETFs and pooled accounts may face renewed scrutiny over allocation practices, especially if delivery obligations outpace available inventory. All of these developments converge toward a single implication. The market is entering a phase where silver behaves less like a commodity and more like a strategic resource. The rule taking effect in 48 hours accelerates that transition by forcing alignment between contractual claims and tangible supply. It narrows the gap between paper structure and physical reality. And once that gap closes, the trajectory of silver will be shaped by fundamentals that have been building for years. Rising demand, constrained supply, global competition, and diminishing inventories. Markets can adjust, but they cannot manufacture metal that does not exist.